So ROI, return on investment, what does it mean? Now this video is going to be perfect for you if you're looking to invest on the Costa del Sol. Sean, it's something that comes up a lot. What are we meaning? Let's do a dummy's guide. Is that what it's called?
I'm the right person.
Dummy's guide to ROI. What does it mean? And how can we?
It means
benefit?
different things to different people. It shouldn't be looked at as a blanket thing. So, investment. People look at property as an investment, and there's two ways you can make money from property. One is capital growth. So you buy a property at 200,000 euros, and in the next 10 years it's gone up to 400,000 euros. So you've doubled your money. Pretty good, yeah. The other way you can make money is from an income. So that would be rental income in this case. So you have the property for 10 years, and in that time you rent it out for, I don't know, 1,500 euros a month. So that's, what's that, 18,000 a year? That's a lot of money. And you do that for 10 years, you've made 180,000. So there's two different ways of looking at it. Capital growth or rental income, ideally both. But to determine which one you should aim for really depends on where you are in your life cycle and your own monetary cycle. Because if you're young-ish, younger than me, and you have a good job and you've got a good steady income, you probably don't need an additional income. You probably want to try and make your money, your capital, grow as much as possible. So it might be that you buy multiple properties and hope and expect that they will appreciate in value. And then when it comes to retirement, when you need an income from somewhere, you can dispose of your property portfolio and cash it in and get an income from the money, or you can simply take the rental income from those properties that you've accumulated over the years, and that will pay for your retirement. So different ways, and it depends on where you are in your life. For instance, I'm 56.
Are you really? Goodness me.
You know, and my time will come soon where I don't want to be doing all this crazy
so
stuff.
You've been looking around lately for investments, haven't you?
Yeah, and it's a different type of investment.
Yeah.
So I have apartments that I rented out long term, and they provide a very decent return indeed. But I might look at cashing some of those in and converting them into other assets that provide a higher income. I don't know. Yeah. I'm not at that stage yet where I need that additional income, so I'm still looking to grow my money.
All right, yeah. So risk-wise, what do you think some of the risk could be if somebody's got an idea that they want to have a good investment? Yeah. What are we looking at
with property, it's always got to be looked at as a long-term hold, in my opinion. Some people have made money very quickly, like you say in another video. You know, during the post-COVID boom, people have doubled their money, so they bought property at €1 million and it's now worth €2 million. How cool is that? That kind of sets you up for life, doesn't it? But the risk is that you buy a property at €1 million and a few years later it's worth 500,000 euros. So then you've made a loss. So what you've got to decide at that point is, okay, do I sell and take a hit for $500,000, or do I hold and wait for the next cycle of growth to come where that property will be worth more? And that's, again, it's a personal matter. It depends on, do you need to dispose of the asset? Because if you do, then you're going to take a hit. Or can I hang on and wait for the next cycle of growth? The beauty of property is that even in a downturn cycle where you've lost money on paper, you should still be able to rent that property out. So if that property has gone down from $1 million to 500,000, ooh, yikes, don't sell. Yeah. You know, let's rent it out, get a good, healthy income.
Hold on to it.
Hold on.
There's always that sort of knee-jerk, got to sell, got to get out when it's gone. But actually, if you can hold in there, sometimes
What was it George Soros or Warren Buffett once said? You know, when people are buying, you should be selling, and when people are selling, you should be buying. And it's absolutely true. But of course, at that moment, you're like, everyone else is selling. What am I doing buying? And you know, sometimes they're the best bargains.
Yeah, sure. So a few options of what we can do with our investment. Obviously, we can long-term. Yeah. We can short-term.
On the rental side, yeah.
On the rental side, yeah. Or we can perhaps use it ourselves, have a bit of a hybrid thing. There's a few options there, but now we're seeing a few restrictions coming in. So it's important to do a due diligence and make sure that you get it for what you need it to achieve as well. I mean,
I've got, I think, 3 rental properties. They're all rented long term, and they produce a gross return of about 8.5%.
Great.
Now, the difference between a gross return and a net return. So a gross return is the rental money that you're getting every year as a percentage of the purchase price of the property, or the valuation of the property. That's a different matter. So that's a healthy return. But what's really important is your net yield, which is
Yes.
when you scrape away all of the costs. Because obviously you might have 1,500 a month coming in. That's 18,000. Fabulous, lovely, lovely. But your costs might be so extortionate that you don't see any of that money. So you might have mortgage costs, you might have community fees.
Because that's often absorbed, isn't it? Because the renter wouldn't necessarily be paying any of those associated fees.
Exactly. Now, a lot of people, what they do is they use financing, they use a mortgage to leverage their position. So it means that the rental is paying the mortgage, but obviously the mortgage is being paid off. So you're acquiring more equity in that property, and it's kind of the cash is netting off. You're not seeing anything every month, but your true share of that property is going up. And if it's going up in value as well, then even better. That's why it's a great, normally property is a great long-term investment. But the net is important, because if you have community fees of 500 euros a month and you're getting 1,500 euros a month, you're only actually getting 1,000 in your pocket. Then you've also got your bills, if you're paying bills or if you're paying local taxes. So all of a sudden your gross yield of 8% comes down to 5%. Could I get a bit more from another property or somewhere else? So investors need to look at what the costs are going to be, as well as that headline rental income. Because a lot of communities, if they've got 24-hour security and they've got this and that, the community fees will be high. And that is a fee that you as the landlord pay, not the tenant. So that really eats away at your margins.
And what would you associate a good, healthy net would be?
I think a good healthy net, again, depending on where you are and what you're using the property for. So on a long term, it's getting harder to find. I mean, I'm looking for one at the moment, and because I'm looking for a 3-bed. And again, investors can look at this, because there's a lot of 2-bed stock on the market for rental, and there's a lot of 2-bed properties on the market for sale. The simple reason being that that's what developers build most of. The 3-beds, though, if you have a 3-bed in the same block of apartments as a 2-bed, and the 3-bed is 20,000 more on a 300,000 asking price, go for it every time. If it's 100,000 more, okay, it might be a rarer type of property, but am I going to get that extra 100,000 back? So you've got to look at the differential. So I bought a property in Los Arqueros, a 3-bed, last year for 325,000 euros. Now you can't buy a 2-bed for 325,000 euros. So that for me was a really solid, good investment, and I'm getting a decent rate of return, a good rental income, and it's not costing me a lot to keep that property up to scratch. So yeah, you've got to look at what you're going to want. If you want some personal usage out of the property, that's a key thing, because if you want to use it in the summer, you and your family, for 6 weeks of the year, you're taking away the best 6 weeks potential rental income. So you can't have it both ways, really. But what a lot of clients do is if you're allowed by the communities now, of course, is that they'll use the place as a holiday home for them and their families, and they'll maybe rent it out for 10 or 15 weeks a year, and that normally covers their running costs and maybe their mortgage as well. And that means that their holiday home in Costa del Sol is costing them nothing, really, apart from their initial capital expenditure, and it's providing them with 6 weeks of holidays a year.
Obviously subject to short-term rental restrictions as well, which what you've got to do when you're looking into this there.
The other option is that you rent the property long-term to a tenant. You're guaranteed the same figures every month. The only problem is that you can't use it yourself, obviously. So that is a pure investment. Or the other option is you just rent it short-term, don't use it yourself, and make sure those really attractive months and weeks are given to people who are going to pay you top dollar.
I think what we've seen as well, people mid-term, so they'll have it, the peak times it's gone back to holiday short-term rents, and then out of season, they've said to somebody you can have it for 6 months up until June, and then we're kicking you out. You can come back in November or whatever it is.
I think the minimum term to be considered a long-term rent is 30 or 60 days. So it means that if you have maybe a Scandinavian family who want to come, or a digital nomad who wants to come and rent it for 3 or 4 months, it's great. So there are openings, although some things are being closed off. There are openings for other types of rental. But yeah, there's different ways to look at it. It depends on what you want out of it as an investor, and also the different yields that you're expecting. But certainly on a short-term let, if you're in the right location, and this is where it's really important, location, those fundamental kind of buying criteria should always apply, even for investment. If you are if you imagine looking at an Airbnb advert where it's like, walking distance to amenities, satellite TV, air conditioning, you've got to tick as many boxes as possible to get people to stay in your property. The photos have got to be top class. It's a competitive industry. But the better the location you're in, the more occupancy you're going to get. If you're out on a golf course, yeah, you might get people who want that peace and quiet, but you probably won't get the golfers that you're expecting you'll get, because the golfers want to be where the action is. They want to go for a pint and a pizza after a round of golf. They don't necessarily go and want to spend the week living on a golf course as well as playing a golf course. So you've got to be careful. And this again comes down to choosing an agent that understands the different nuances in the different markets. But sorry, I keep fudging the question. But in terms of a gross return on long-term rental, I would say 8%, net return 6 to 7. On the short term, if you choose a good location, you would probably expect gross returns about 10%, and net returns, because of the extra costs involved with changeovers and agents' commission and stuff like that, you're probably looking at 5, 6, maybe 7.
But then you've got the benefits of using it if you want to use it as well.
You've got that flexibility, yeah.
Also, there's lots of different options to choose from there. And the good news is you can make it work. It is doable, but you've got to take your time with it, speak to the right agent that can help you, pick the right areas, the right location, and it can work. But you've got to do your sums as well, haven't you?
And these places, they don't rent automatically. Do you know what I mean? You've got to put some effort in. You've got to either pay someone to do it, or you've got to market the hell out of it through your own sources.
What would you say average is healthy occupancy if you're doing a short term? What would you expect?
I think you've got to be aiming for 20 weeks. Because, I mean, I've had properties in the UK that are rented by night, and so you aim for the number of nights across a year. So I had a place in Bath, and we always used to consistently achieve 200 nights. Which is pretty good, but the problem with But the problem with that was a lot of them were short stay, like weekenders.
Yeah.
So your changeover costs.
And these changeover costs now they're quite expensive, aren't they? Getting the cleaners in there and things like that.
Change of linen, cleaning, meet and greet, kitchen packs, all that sort of stuff does cost money, and it eats into your margin. Costa del Sol is different, unless you're in like Malaga City. It's normally a week or 2 week stay, so the changeovers are minimal. So yeah, I think 20 weeks, you might not achieve that in year one because the property might not be known. It might need a little bit of a push. I mean, I've got clients who rent for 30, 35 weeks a year, but they're in prime locations and they've got a good rental track record. They've got good reviews on Airbnb and Booking.com, so they have returning visitors. But yeah, 20 weeks is a good one to sort of aim for, I think.
Question for you: short-term or long-term rental on your investment? What do you think is probably I know it's very. It's hard. It's a tough one.
I mean, for me, I did the maths, and there's not a huge amount of difference when you get down to that net return. So the gross return on short-term rentals is always going to be higher, but then when you work out the costs, the net return on both models is probably going to be quite similar. So again, that will maybe come down to your personal. Do you want to use it yourself? Sure. If you want to use it yourself, you have to go short-term. If you don't want to use it yourself and you just want a consistent income and hopefully capital growth over time, then you probably go long-term. And there's a shortage of good quality, well-furnished. Again, it comes down to how it looks and feels when you walk in. It's like buying a property. It's the same thing. These families are walking in saying, could I live here? Could I rent here? And if it's a mess and it's full of old crappy furniture, then they're going to go on to the next one.
Yeah, for sure.
So you can't miss things out. You've got to do it properly.
Yeah, some great advice here. Key takeaways then. Obviously, if you're looking to get that return on investment, do your research, due diligence, find a good agent that can help you out with that specialises in that could offer you the best advice there as well.
And I think what I would do is, if I was sitting down with a potential investor on the Costa del Sol, I would want to know more about him or her. Yeah. I would say, okay, what's your goal? How old are you? Where are you at with your life cycle? What sort of investment do you want? Do you want this to make you a load of money over the next 10 years because you're in maybe an area that's up and coming, or do you want consistent income, or it depends on their risk profile. So you've got a lot of qualifying to do normally with an investment client, and it might be things that they hadn't even thought of, and then you can work really well together as a duo.
And actually, if the agent's actually done it as well, walk the walk, and they can talk.
It does help.
Brilliant.
Because, I've made loads of mistakes, and it's only by making mistakes that you avoid making them in the future.
Yeah, exactly. So Sean, there's two other areas as well that we haven't necessarily covered, but it's worth talking about. We could do a deeper dive in future videos because I think they're really, really important as well. One of them, of course, is looking off plan.
Yeah.
Now, why would that be advantageous?
Okay, normally in a market that's going along quite nicely, what developers do is when they're launching a new project, they will actually offer units in that project at what they call pre-release pricing. Normally before a license has even been granted. So you've got to be a little bit careful about where you're putting your money. Normally it's with a lawyer, not the developer, until they get their license, because then the bank guarantees kick in. But what the developer will do normally is they will price those units at the lowest possible level, because what they want is they just want to get some sales activity in, maybe to show their bank that they're lending the money from that sales activity is moving, and normally they need to sell a certain proportion before they get their finance, blah, blah, blah. So effectively, you are buying at the lowest possible price. So you might be paying, say, 300,000 euros for a 2-bed apartment in Estepona. And what you would hope, and what the developer will tell you, is that during construction, those prices will go up. And it's something all developers do. You know, if they see that they've just sold 10 units in a month, they'll load the prices up again by 5, 10, sometimes 20%. So you as an early investor, almost an early adopter, are basically being rewarded for being early by seeing the prices rise. So you could, as I say, buy for 300,000 euros, and by the time completion of the project comes, maybe 2 years down the line, your property might be worth 400,000 or 500,000. Wow, that's amazing. Now, just one word of caution: just before the last financial crash of 2008, a lot of people were doing this, and what they were doing is they were what's called flipping the properties. So they were being sold these properties, and they were paying a certain amount towards the property, normally the contract sum, which would be maybe 30%. But before they had to pay the big chunk, the 70%, and all their closing costs, they were being allowed to sell their contract to another person, maybe someone who wanted that unit ready in 2 months rather than having to wait 2 years. And the original buyer was making a lot of money. That overheated the market. So opportunities like that are fewer now. A lot of developers don't allow that, so you have to complete on the property because they don't want the same level of speculative investment that there was way back in those days when it got a little bit out of hand. So normally you have to complete the purchase. But if you want to flip it, ask. The developer might allow you to do it. And if it's a project where you really think there's going to be that capital growth before completion, and you've bagged yourself a really good unit that you know will sell again, it's an option. It really is.
So you mentioned flipping there. There's another term with flipping as well. Flipping is that you could buy somewhere and kind of do it up, get a bargain. There's a few knocking around, but not many. There's not many, is there?
Well, it's interesting because some agents are doing this as well, because it's actually financially advantageous for agents to do this, and I'll tell you why in a minute. But it is definitely a great route for to good investment, because you can buy a property, you can hammer away at the negotiation until you get that property for rock bottom. It can be a mess. You can spend an amount of money on it, but you need to have a team in place to do the refurbs. We know, both of us, how difficult that can be. And then you sell it at a margin that gives you, a fantastic price and pays for your next one. So there's definitely money to be made there. You've got to be careful. And the biggest drawback has been that because the buying costs and selling costs in Spain are high, normally it's about 10% to get in and maybe 6-7% to get out. So unless you're clearing 15-16%, it's not worth doing. However, if you have an SL company that is a trading company involved in real estate and development, then you pay a special transfer tax. Rather than you paying 7%, you pay 2%. But you have to dispose of the property within 5 years, and you can't use it yourself and you can't rent it out. As soon as you do, then that extra transfer tax becomes payable. But if you're doing it purely to refurb and sell on at a profit, that is the way to do it. You pay that lower rate of transfer tax, so it brings your opening costs down from 10% to less than that, 4-5%. So it really does mean that you've got more margin to play with.
Great stuff. Good advice as always. Thanks, Sean, for that.
No problem.
Nice to chat, isn't it?
It is nice to chat.
Chew the fat on that.
Absolutely.
Yes, great stuff. Well, until the next time, from Sean himself, it's bye for now.